Ladies and gentlemen, welcome back to the channel. AMC stock on Friday did not have all too great of a day. And what happened Friday and after hours could cause, well, an even bigger problem for our markets. Moody's downgraded the U.S. economy. What does this mean? What could this cause? And what do you need to know as an investor in AMC stock? There's potentially a good outcome to this as well, or at least one that is maybe not so bad. And this could actually be very positive for AMC stock. Perversely. Let's go ahead and get into all of this information. Hit that like button and or subscribe to the channel. Let me know down below in the comment section. What is your opinion on this situation? And let's go ahead and jump into it. So really, first things first, let's just get into the meat and bones of this. Moody's cuts the U.S. outlook to negative, citing deficits and political polarization. Sounds familiar. We've gotten 2 downgrades in 2023. Now, Moody says, in the context of higher interest rates, without effective fiscal policy measures to reduce government spending or increase revenues, the agency said, Moody's expects the U.S. fiscal deficits will remain very large, significantly weakening debt affordability. Brinkmanship in Washington has also been a contributing factor, Moody said. Continued political polarization within U.S. Congress raises the risk that successive governments will not be able to reach consensus on a fiscal plan to slow the decline in debt affordability. That is saying that basically whoever gets in office next is starting in 2025, no matter who's the chair, the Speaker of the House, it doesn't look like they're going to come to agreements to be responsible with their fiscal policy, meaning they're spending like they're drunk and they're going to stay drunk for a long time. So, what are the 2 ways you see a more affordable debt payment? 2 ways. One is Congress comes together. And this is the slow course. Congress comes together, they set up a plan to reduce deficits and to get their budget in alignment with, their income, essentially. It'd be like an intervention on your girlfriend that spends all your guys' money, or your wife. Well, that's possible. Usually there's hiccups along the way. Usually it doesn't go perfectly, okay? And it takes a long time. Second, and could just be impossible with the current state of politics and the government. So yeah, it would look very unlikely at this point. The second way is the Fed reducing rates. When the Fed reduces rates, it does help debt affordability. Now, a lot of this debt that the Fed is issuing, the almost $2 trillion just within the last 6 months or so, well, that's going to be at high interest rates, like 5%. But any further debt would be a little bit cheaper. And that is important. So those are the 2 ways that you can actually reduce your fiscal obligation, right? Your debt payments. Now, Moody's says, as far as keeping the nation's rating at AAA, Moody's said that it expects the U.S. to retain its exceptional economic strength. Further positive growth surprises over the medium term could at least slow the deterioration in debt affordability, the agency said. While the statement by Moody's maintains the United States AAA rating, we disagree with the shift to a negative outlook, said Deputy Secretary of the Treasury, Wally Ademo, in a statement. The American economy remains strong and Treasury securities are the most preeminent, safe, and liquid asset. Well, yeah, there's a lot I could disagree with there. Like, the economy remains strong. Ask anyone out there. It's not. People are struggling. They're not doing well. So, I would expect the government to say nothing less or short of what they just said. But, yeah, I think Wall Street's been seeing through that for a while. Now, Moody's decision to change the U.S. outlook is yet another consequence of congressional Republican extremism and dysfunction. White House, that just shows you, like, the government's not going to come together and stop spending money. Like, not even being political here. They just blame conservatives for their spending habits, or for the government spending habits. What? Yeah, oh my gosh. That's just crazy to me, okay? The people that want to spend less money are the ones getting blamed for spending too much money. Or you really can't make this political crap up, okay? It's just insane at this point. Now, furthermore, to the point of the markets and what kind of effect this could have to our stocks and our portfolios. So this has happened a couple times. First thing that I guess we should start with is the rating itself. Moody's keeps the rating at AAA. Okay, so you have kind of like a stock, right? Where you have an analyst, they give it a price target. They also give a stock a hold, a buy, a sell, a underperform, an outperform, an overweight, right? Different ratings. So Moody's basically just cut our rating today to negative, saying, you know, these factors are just causing them to be negative on the US. They didn't change the actual rating itself. So it'd be like downgrading, AMC from a buy to a hold, or from a hold to a sell, but keeping a $10 price target on the stock. Okay, that doesn't have that big of an effect. If you were to like downgrade the stock and cut the price target, well, that would obviously be a little bit worse. So this is not as bad as some of the other downgrades that we have seen. Now, back in 2011, S&P downgraded the long-term credit rating from AAA, representing risk-free, to AA plus as early as 2011, citing political polarization after another debt ceiling squabble in Washington. Political polarization, that continues to get brought up in every one of these downgrades. And as you can see from Moody's, they have AAA. S&P downgraded to AA. It's been at AA now, and it's never changed. And Fitch earlier in this year, on August 2nd, downgraded the U.S. from AAA to AA. So, I mean, Moody's is the last one to take that step to actually downgrade long-term U.S. debt. That did not happen. So I think if you were to see a muted response in the market, that would probably be the reason why, that the actual rating itself did not get downgraded. Now, the S&P fell about 7% following the S&P downgrade in 2011. It was a pretty rough time overall, and the NASDAQ dropped about 6% when this actually happened. Now, the NASDAQ was falling for a while, but that 6% drop was a big one at the time. This drop from the high September 26th, 25th or so, 2011, down to the low was a fall of almost 17% within the course of like 2 weeks. So it was a very aggressive move lower at the time. Now, if you take a look at the most recent downgrade that we've seen on August 2nd, 2023, you're gonna find something similar, not as extreme though. Markets went up a lot compared to then. So August 2nd was, let's go ahead and see right here. The NASDAQ dropped about 2.2%. Now, I should also mention Fitch is like the lower tier rating agency, right? You have S&P, you have Moody's, you have Fitch. A lot of people don't even care about what Fitch rates things as. Like S&P and Moody's are the top dogs, and Moody's has never like changed the US rating in a very long time, at least not in like any kind of recent history. So this could be a big deal, but again, they didn't change the credit rating. Now, from the basically the day before this downgrading, back in August, you ended up falling about 7.5%. If you wanted to say our lows down here, because it was just back in August, then we dropped about 11% total. And now you're making your way back up there. You have another downgrade. It's maybe not as bad, you could argue, because they didn't change the credit rating. but I imagine it can't be a good thing. Now, this comes at a very weird time where the NASDAQ is in a cup and handle formation with a technical breakout, like literally happening right now. So you have your cup, you have your handle, and now you're starting to, break out to the upside. And usually cup and handles, when you actually break out, can send you, higher than your actual cup, right? Higher than the handle, higher than the cup. That could put the markets at new highs. Now, I don't know if that's going to happen. It's possible. As long as inflation were to come in lower than expectations and, nobody freaks out about this downgrade, that's certainly possible. And it looks good as of right now. But the main thing this will do is it makes debt more expensive. Now, government debt becoming more expensive, what does that mean? That means treasury yields going higher. We've seen this correlation lately for a while now. Treasury yields go up, stocks go down. Treasury yields go down, stocks go up. And you did see a little pop in treasuries in after hours on Friday. I don't think you're going to feel that whole reaction, though, until we start the trading day on Monday. Now, next week, you're going to have inflation data. You're going to have all kinds of things that will also be important that could move our markets. But this is definitely going to be one of them people react to as well. And that's really the bottom line. It in theory will move bond yields higher. That should be negative for stocks. Question is how high, how much do people react to this? I don't know. The precedence is, falls anywhere from, call it 11% to 17%. I don't know. Could it be 5%? Maybe. Could it be nothing? Maybe. There is a bullish outcome, and that is there's going to be a lot more pressure on the Fed to lower rates if yields go higher. Fed Jerome Powell just said at the last Fed meeting, if the dollar goes higher, if bond yields go higher, if stocks go lower, that could change Fed policy. Basically saying we might cut rates if long-term treasuries continue to go higher. Because at this point, the Fed knows the only inflation that's really left is in housing. And there's a chronic problem in housing. It really doesn't take a genius to figure this out. If I'm some guy on a computer at his house and I can figure this out, well, the Fed certainly can. Back in 1960, we were building more houses every year than we are today. And the population was 160 million people in this country, in the U.S. Today, it's probably closer to about 370 million, including all of the immigrants that have came to this country within the past couple of years. The last census was around 340 million people. So assume 30 million people or so have come into the country in the last couple of years. I think that's probably the reality of the situation. Well, there's a chronic lack of housing. The Fed raising rates is not going to do anything to housing. I mean, that's just the bottom line to it. There's too much demand because there's not enough supply. So with that being said, the Fed does not want to keep super restrictive policy on the economy. They're already at a 2+% drag on the economy. That's taking the Fed funds rate, call it 5.5% minus the inflation rate, which 1-year inflation expectations are around 3%. Well, that means your net restrictive like 2.5%. So with that being said, that could cause the Fed to cut rates maybe a little bit sooner, and that could be very bullish for stocks like an AMC. Let me know what you think about this down below in the comment section. Hit the like button as well as subscribe to the channel. Source your comments, questions, or concerns down below in the comment section. You guys have a great rest of your day, and I will see you in the next one.